Hello, welcome to question number 4, February-March 2023. Well, invite your friends to watch this video. Don't let them miss out. Let everyone know what's going on here. Adia is a trader. She buys and sells one type of good only. She has provided the following information. Alright, this question is about ratio analysis and comments on that. There's some ratios to calculate and then you have to comment on them. Okay? Just to be clear what we're about to do. So let's look at the information. She buys and sells one type of good only. She has provided the following information. We have revenue, purchases, expenses, and other income. All right. We have some information about inventory as well. And it seems like that's closing. Everything here is closing. All right. So the inventory must be closing, trade receivables, payables at the end of the year, right? The inventory quantity and valuation at 31st October 2022 is double those at 31st October 2021. So this must be 7,500. Since that is double, half of that is, just to be clear, we'll use calculator, divide by 2,375,000. That's the inventory. That was the inventory at 31st October 2020. We can say opening inventory, okay? That's opening inventory, and that's closing inventory, okay? That will be relevant at some point. Let's just see what we need, okay? We first need to calculate the gross margin, and for that, you know the formula. You take gross profit over sales revenue times 100, right? That's your gross margin. And to calculate that, you need to first calculate your gross profit, right? Your gross profit will be, let's see, gross profit equals revenue minus cost of sales, right? So revenue of 98,000 minus cost of sales. We'll do a calculation for that as well. We'll take opening inventory 3250 plus purchases of 62,305, 62,305, and we'll deduct the closing inventory. Opening plus purchases minus closing inventory of 7,500 will be deducted. Okay, that gives us the gross profit. Is everything considered? Yes, it seems. So the gross profit will be 98,000 minus, in the bracket, 3250 plus 62305 minus 7,500, close the bracket, 39,945. 39,945. That's our gross profit. Now you may use the formula, obviously. Gross profit is 39,945 over the sales revenue of 98,000 times 100, okay? Which gives us, let's see, 39,945 over 98,000 times 100 gives us 40.76, 2 decimal places. 2 decimal places, okay? The answer is 40.76%. All right, let's confirm everything is considered. Revenue, purchases, yeah, everything considered. Fine, let's move on. Yep, just to be clear, no mistakes. Profit margin. For that, first you need, well, let's put the formula. It's profit, it's margin, so as a percentage of sales revenue times 100, right? As a percentage means times 100. As a fraction of the sales revenue times 100 to make it percentage. Now, the profit calculation is simply your gross profit, which is 39,945, 39,945 minus, oh wait, plus, sorry, plus the other income they provided, 4,630, 4630, and the expenses will be deducted. 31188 minus 31188. Your income statement must be strong. The concept of income statement must be strong, so you know how profit calculations work, how to find gross profit, and how from there add the income, subtract expenses, how to get to the profit as well. Your basics must be strong enough. 39945 plus 4630 minus 31188. I just want to make sure of that figure. 31188, 4630. That's right. And that's 39,945, right? 13,387. 13,387 is our profit for the year. Okay. Now we can use that formula. You can say 13,387. Remember the sales revenue was 98,000. Let's be clear with that. Yes, that was 98. A second check, that's 98. Okay. Times 100. All right, let's see. 13,387 over 98,000 times 100 is 13.66. 13.66. Okay. Percent, of course. 13.66%. Be careful what they're asking for. They want 2 decimal places. That's what they normally want. But just look at the question, make sure that's what they want. Okay. Rate of inventory turnover. Do you remember how to calculate that? There are 2 ways. It can be number of days or it can be number of times. Here they haven't clarified, so we will just go with the number of times. Okay. We'll just go with the number of times. Otherwise, they would have mentioned in days, in weeks, in months. But here, no mention of that, so we just go for times. And when you have to calculate ROI, well, there's no way to put it shortly, but return on inventory turnover, if you want to calculate that, you take cost of sales over average inventory. Okay? If you look it up on Google, you will find different methods, but this is the one you have to follow according to your syllabus. Okay? If we're looking for number of times. Got that? The mark scheme is not out for this one, but it'll be interesting to see if they accept both days and times. However, I would say just go with the times because there's no mention of giving it in days, right? So just go with rate of inventory turnover in number of times. Use this formula, okay? So what is cost of sales, first of all? Cost of sales. It is what we did above. It's that part. Opening inventory 3250. Let's just do that again. 3250 opening inventory plus purchases of 62305. 62305 minus closing inventory of 7500, which gives us cost of sales of, let's see, 3250 plus 62305 minus 7500, 58055. 58055. That's cost of sales. What's the average inventory? Let's have a look. Average inventory would be just, what you do is just add up your opening and closing inventory, which is 3250 plus 7500 divided by 2 gives us, let's see, 3250 plus 7500 divided by 2 is 5375. 5375. Put that in the formula. It's going to be 58055 over 5375. 58055 over 5375 gives us 10.80. So in the calculator, it gives us 800930 and so on. just give 2 decimal places, even if it is 0. Okay, and just make sure you give the the measure as well. That's the number of times. Okay, the unit of measurement. 10.80 times. Okay, and then we have the liquid acid test ratio. Hopefully you understand what this is. This is where you take, it's just like current ratio, where you do current assets is to current liabilities, but without inventory. Okay, so we can have a look over here. And also it is for the last date, if I'm not mistaken. Yeah, because this can be done at the beginning of the year or at the end of the year. But if you notice, we only have the inventory figure at the beginning of the year. We don't have any other figures at the big. The point is, we're at 31st October 2022, so we will be calculating these ratios for that date. Okay, just keep that in mind. I mean, it's pointless to go, even think about calculating opening balances, because there's no context there. Like there's no opening balances provided except for inventory. Okay, so you're doing everything for the closing. Anyway, let's get back to point. For this, what we do is current assets minus inventory over current liabilities. So your current assets minus inventory can be done by calculating all the current assets including inventory and then deducting inventory, or simply ignoring inventory in first place. All right, both will give you the same answer, of course. So current assets without inventory is we can say that's your trade receivables, and that's it. Really, that's it. Yeah, 9240. 9240. Again, we ignore the 7500. We don't take that. Okay. And for the current liabilities, we have trade payables and bank order 5365 5135. 5365 plus 5135. 5135. That looks like a 6, so let me change it. 5365 5135. That's our current liabilities. Okay. 5635 plus, oh wait, 5365. Confirm once again. Plus 5135 will give us 10500. 10500. Put that in the formula. It's going to be 9240 over 10500. 9240 over 10500. It's 0.88. You know what that means? That means it is 0.88 is to 1. That's what it means. So for every $1 of current liability, we have 0.88 of liquid assets. Okay, these assets are liquid, means they're very easily convertible into cash. Well, as you can see, it was actually just one item, that is trade receivable. And it's easily convertible into cash. It's just one step away. You can request your customers to pay and they will pay, hopefully. Inventory is not considered as a liquid asset because it's 2 steps away. You first have to sell the goods and then you need to recover the amount. So that's why in liquid ratio, inventory is excluded. Okay, so the ratio is 0.88 is to 1. See the way all of them work? So we have percentage here, times, number of times here, and there's a ratio. You must be familiar with this, guys. Let's move on. Adia's purchases price has remained constant through both years, 31st October 2021 and 2022. So the purchase price didn't change, didn't fluctuate much. The following information relates to Adia's business for the year ended 31st October, means the last year. Let's just quickly compare it with our present margins, right? Or let's just say 2022, and that's the last year. 2021. We're talking about October, of course. It doesn't matter. The point is that's the new year and that's the old one. In the new year, the gross margin is 40.76, 40.76, and the what else they want? Profit margin is a little bit worse, I think. 13.66. 13.66. You may or may not do this in the exam, but it's convenient for me at least. All right. 13.66, and then we have 10.8 times, 10.8 times, and then we have liquid ratio of 0.88, 0.88. Okay. So, okay. Comment on changes in gross margin. By the way, if your calculations are slightly wrong or even significantly wrong, the examiner will give you own figure marks. So instead of 40.76, let's say you got 20. Now you will be answering based on that. You'll be answering based on the reduced amount. So you will comment negatively. You will say gross margin has gone down. Okay. In our case, it has gone up. So we'll comment based on that. Okay. So you won't be losing any marks for analysis from your own perspective based on your own answers. You get it? If you make a mistake above, it won't affect your marks over here. Just give it based on your own answers. All right. Hopefully you all understand that rule, the OF, the own figure marks. Okay. What has happened? Gross margin has improved slightly. There are multiple ways to put your analysis, but I'm just going to give you some points. Now, this is not the way you're going to write your answer, but these are some points you can include in the whole sentence. Okay. It says the prices remain the same, so it must be the selling price. They may have increased, let's say, increased the selling price since the purchase price was constant. Okay. Was constant, yeah. So that's the only explainable reason, really. So gross margin is affected by two factors. One is your cost of purchase and your selling price. Okay. The quantity doesn't affect the margin. You will make more profit if you sell more, but it's the price itself. If it's higher, that's going to increase your margin. So price is higher and cost is the same, you will increase your margin, right? So it seems like these are the only 2 points I can give. If more comes to your mind, though, just drop them in, right? Drop them in the comments or just note them down, all right? The liquid acid test ratio, what can we comment on that? So the liquid ratio has, let's say it was better in, or let's say it has slightly worsened, but is still acceptable, right? Isn't it? So it's not too bad. 0.88 quick ratio is not too bad, actually, because we're not including inventory, we're ignoring that. So it's slightly worsened as compared to the last year, but it is still acceptable, right? You can say last year's maybe considered a bit too much, right? Because up to 1:1 is good enough for a liquid ratio. So it has slightly worsened or gone down, but is still acceptable. Secondly, you can say closing inventory is much higher this year. You know what that means? That means if inventory is higher this year, it means a lot of your money is stuck into inventory. Okay, a lot of your current assets are stuck into inventory, and inventory is not part of this calculation, and inventory is excluded from quick ratio. Okay, so that's a comment we can give. That's a factor. This is an explainable reason, or this is a justification for this year being slightly lower, right? Closing inventory much higher this year compared to the last, because if you remember the opening inventory, which was closing of the last year, isn't it? It was half, okay? Or we can say double. Say double. All right, of what it was the last year. And that's why quick ratio has fallen. Okay, not necessarily due to bad performance. We can say not necessarily, or that's enough actually. Yeah, that's two good points. Of course, there will be more points you can come up with, right? Go ahead and note them down. Okay, let's just move on. By the way, there is no need to analyze profit margin, right? Because it's not relevant in any of these two. Anyway, let's keep moving. Let's see what's next. Adia is concerned about the increase in inventory over the year to 31st October, which is this current year. She is considering reducing her selling price to increase the quantity of goods she can sell. So it seems last year the margin was higher and the cost was the same, means the selling prices were increased. The turnover is a bit low, it seems. Is still they're not managing profit margins, not maintaining profit margins because expenses are rising. So she needs to control expenses as well. That's one thing. So okay, so her concern right now is inventory, isn't it? Advise Adia whether she should reduce her selling price. Let's see. There are two things: reduce or not to reduce. Okay, why should she reduce her selling price? Reducing price will make her more competitive, right? Increase demand for her products, right? Increase demand. What else can we say? Inventory costs will fall, isn't it? By reducing price, inventory will be sold, and inventory costs, storage costs, like be more specific. Inventory storage costs will fall. Let's say chances of damaged inventory will reduce because we'll have less of it, right? Okay, obsolescence will also, inventory obsolescence can also be avoided. Means inventory will not go out of date. Before it goes out of date, it'll be sold. So these are in support of reducing the selling price. Okay, you can come up with your own points. Reduce selling price. Never write your exam answers like this. This is just an outline, just some bullet points. You must write your answer in a proper paragraph manner. Okay, points for not reducing selling price. What are the points? Well, she can try and focus on advertising her products instead. So to increase demand, okay, rather than reducing prices. What else? What other reason she should not reduce selling price? Okay, one more reason. It will reduce her profit margins, or let's say gross profit margins. Okay, so that's also good. Or just say profit margins in general, because even profit margin will be affected. So profit margins. It will reduce her profit margins. All right. Yeah, that's looking good. Very nice. I think that's enough to get 4 marks with explanation. You have to explain these points in a proper sentence. Okay, these are just bullets. Turn that into a nice paragraph, and you'll be good. And finally, there's conclusion. It's up to you. You decide, should she reduce the price or not? I would say yes, reduce it because of all these points, right? Reduce so that the the the, the storage costs will fall, obsolescence costs will be avoided, and all that. Uh, okay, next one. One of the limitations of financial statements is that there is a gap between the end of financial year and preparation of financial statements. Explain how this limitation may influence Adia's decision about whether or not to reduce her selling price. Wow, this is also a very rare question. I don't think I've seen this before. So, as you know, when the year ends, financial period, let's say, ends uh, 31st December 2000, 31st December 2020. Okay, the financial statements will be prepared in the next 2-3 months, right? They won't be instantly available. They'll be prepared for an upcoming period. Now the thing is, the result of reducing selling price will not be reflected on current year's financial statements, right? Isn't it? Statements. So that's one thing which will influence a decision. She should consider looking at market conditions at the. Wait a minute. Explain how this limitation may influence Adia's decision about whether or not to reduce her selling price. Wait, we can remove that because that's an opinion. That's an advice. We're not looking forward to give her an advice, isn't it? The result of reducing selling price will not be reflected on current year's financial statements. So she may be reluctant on reducing the selling price, isn't it? However, it will still impact her performance in the current year, or in the current year end. Okay, at the current year end, we can say at the next year end, we can say at the next year end. So she may still decide to reprice her products. Okay. Isn't she the one selling just one type of good? Or that was another question? Yeah, just one type of good. So just product, okay? Okay, so that's just one example answer you can drop. The result of reducing selling price will not be reflected on the current year's financial statements because that's gone. They're already, the new changes made will not be affecting the financial statements already prepared. Reluctant on reducing the selling price. However, it will still impact her performance in the next year. So she may still decide to reprice her products. So that's the influence on her decision. Okay, a very rare type of question. You can just give the best logical answer. I'm still waiting for Mark Scheme to come out and see how they expect you to answer this. But yeah, we'll see. We'll see when it comes out. For now, this is looking good. Okay, this is a nice answer. on this question. Let's just move on. Oh, we're done with this question. Question number 4 done. Now we're left with the last one. See you later.